Hello, everybody. Thanks so much for joining us today for what we hope will be a lively debate about what we believe could be a make or break year for Canada's economy. I'm James Temperton, Deputy Managing Editor at The Logic, and we'll be getting started in just a few minutes. First up, I'd like to welcome any Logic subscribers who are joining us today. If you're not a subscriber and you're interested in becoming one, you can find out more details in the link in the chat. And if you think your team or wider organization should be signed up, we also offer professional subscriptions. Again, you can find more information in the chat. Okay, to kick things off, I'd like to welcome Jimmy Jean, Chief Economist and Strategist at Desjardins Group, to set the scene. Jimmy, over to you.
Thanks, James, and greetings to everyone with us today. So we're only 20 days into the year, and I think it's fair to say that the pace and intensity of events so far come to reinforce just how fluid the global environment has become over the last year. You talk about trade, you talk about geopolitics, you talk about the stability of institutions, be it monetary, global security frameworks, and so on. These were all items that were thought to be almost immutable anchor points behind which we could rely. And now they've become unusually volatile, which means that the job of macroeconomic forecasting, which is already difficult when those things are not in flux, well, it becomes uniquely challenging and sometimes quite frustrating, I would admit, experience. And when you're dealing with a very chaotic environment, it means that you always have to be ready to revisit your hypotheses. So in this case, we need to focus on what we know. And on the trade front, for example, what we know is that the upcoming review of the Canada-US-Mexico agreement will be one of those items that could be a defining moment for 2026, as you pointed out, James. From a Canadian perspective, the direct channel is really through the effective tariff rate, which so far has managed to remain pretty forgiving against Canada on average, relatively speaking. But still, we have key industries in Ontario and Quebec that are suffering right now. And the question is how Canada manages to at least limit further damage and what the price tag that's going to be paid for that to happen. That's where those revisions and that negotiation will be about. But I would say that an important dimension here is really the confidence to invest, because regardless of changes to either the level of tariffs or their composition, businesses really need to trust that trade partners will be holding their word. But if instead uncertainty persists as to whether trade can be weaponized, that will, of course, deter investment. So, in that sense, I'd submit that trade uncertainty today might be less about tariffs themselves. That was probably more a story of 2025, but it's more the absence of guardrails and whether there is an improvement on that front. So that's why you have the strong incentive to diversify your trade partners if you're a country like Canada. Now, last week's announced reinforcement of trade ties between Canada and China. That included, of course, a detente on electric vehicles, on agri-food products, but these are still symbolically important, perhaps, but you look at the volumes involved, they're small. And it's not really the case that Canada has just found a white knight at this point in time. The bigger question is whether those steps could eventually support industrial capacity and manufacturing activity in Canada, something that, of course, will be needed as we think about adapting our supply chains and making them more resilient. Now, on paper, opening participation to Chinese capital sounds appealing, and that's why you have Emmanuel Macron just promoting the idea earlier today in Davos. But really, the reality bumps into the geopolitical constraints. The US seems pretty determined to limit the influence of strategic competitors in the Western Hemisphere. And that in turn places natural limits on how far Canada can safely diversify with a partner like China without antagonizing the US. The other point I'll make today is on productivity, and this is where artificial intelligence enters the discussion. And first and foremost, maybe just to frame this in the current economic backdrop, Canada has shown resilience in 2025, and we're expecting that to continue in 2026. But having said that, growth is weak. We're tracking something close to stagnation in the final quarter of 2025, and we have 2026 likely to remain sub-potential in general. We have about 1.25% annually as our forecast. And a major driver behind this weakness is demographics. So temporary resident populations are contracting fast, and we're contemplating population stagnation, something we have not experienced in the post-war period. We actually published a note on the topic this morning. It will be available in the link. So all this to say, with less labor input growth, more of our overall growth will need to come from productivity. Now, I'll start with the bad news on AI so far. The data doesn't show a clear link between AI exposure by sector and either employment reductions or by extension on measured productivity gains. The AI productivity correlation right now, at least research tells us that it's essentially zero. Now, for the good news, though, it doesn't mean that AI is ineffective. It means that to date, it has been mostly labor augmenting as opposed to labor replacing, where the gains may still come, in my view. And when you think about the periods in history of major productivity gains, they tend to appear when organizations are forced to maintain output with fewer workers. For example, that's what you typically see in recessions. Again, we're not expecting recession at large, but I will still note that one area where we're seeing restructuring pressure right now is in the public sector, where governments are going to be relying heavily on AI to deliver services amid fiscal restraints. So that was a story last year in the US. It is a story going forward in Canada. How that process goes might in turn inform the private business world in terms of how best to operate that kind of transition. I do think that the bigger upside from AI in the coming years will be via what we economists call multi-factor productivity. And that means things like process redesign, faster innovation cadence, and a better diffusion and leveraging of ideas. But for that to happen in Canada, we need better adoption. Currently, Canada lags the OECD in terms of AI adoption, and there are still some pretty large adoption opportunities in places like construction, like healthcare, where demand pressures are rising, where labor is getting scarcer and therefore more expensive. And I think I'll actually conclude here with two key takeaways of that lag in adoption. The first is on fiscal policy. The more we lag, the costlier these infrastructure projects or the delivery of public services will be, and the less ability to sustain public finances without raising taxes or cutting services government will in turn have. The second takeaway is on private sector competitiveness. The more we lag, the least competitive our businesses are in the foreign markets that we're hoping to access right now. But it also prevents us from unleashing a productivity and innovation virtuous cycle, because our research has shown Canadian businesses that have international exposures are more effective innovators, quicker IP accumulators, and productivity enablers. In any case, I'll leave it there because I already exceed my time, but I do look forward to the insights that will be shared by the panelists today. So I thank you very much.
And thanks to you, Jimmy. It's going to be an interesting year. Trump, trade, tariffs, productivity, Mark Carney's New World Order. We've got a lot to get through. To help me get into it, I've got a few of my colleagues from the Logic's newsroom who are going to help us make sense of the year ahead. No pressure, guys. We've got Kevin Carmichael, the Logic's economics correspondent and editor-at-large, Anita Balakrishnan, who covers Canada's professional services sector for The Logic, and Sharon Lamb, a senior editor at The Logic, who leads our coverage of Bay Street and beyond. Welcome, everyone. I've got a bunch of questions for all of you, but to anyone watching this lunchtime, we want to get questions from you as well. This is your chance to put my colleagues on the spot. So you can send your questions using the chat box on the live stream, and we'll get to those towards the end of our discussion today. Okay, let's get to it. First questions to you, Kevin. Prime Minister Mark Carney was speaking at Davos a little earlier today. He said a lot of interesting things, but one of them stood out for me to quote, "Middle powers must act together because if they are not at the table, because if you are not at the table, you are on the menu." So Kevin, is Canada on the menu? And if so, how can Mark Carney stop us all from being eaten alive?
I think you just answered the first question with the premise of your second question, James. I mean, Canada most certainly is on the menu. Jimmy alluded to it in his remarks, but we shifted into an era of geoeconomics. What does that mean? That's great power rivalry, essentially, is what that amounts to. When efficiency and all the other things we tried to achieve through globalization, the era of free trade, et cetera, no longer applies. So what do the great powers want? Well, they want what they want. Canada has a lot of what the US, China, Russia, perhaps, require in this game that we've entered into, and that sort of amounts to technological dominance and security. So all those players will be eyeing the Arctic when it comes to security, and all those players will be eyeing, to a greater or lesser extent, all the resources that Canada has built its economy on for these past decades. So we're very much on the menu. I think what Mark Carney is doing today at Davos is making a stab at something of game theory and trying to fight against or playing something of a prisoner's dilemma and trying to remind people that, don't cut these deals with these guys just because it looks like it's something in your immediate self-interest. Because eventually you will be gobbled up by these people, or you'll be sacrificing a certain amount of autonomy. But if we find a way, the rest of us that are outside of these great power struggles, then maybe we can find a way to resist all of that together. Your question about what Mark Carney can do, I think honestly more of what he's doing. I spent a lot of time thinking about what Finland did in the aftermath of the Second World War and how it managed to carve itself out from under the menacing influence of the Soviet Union. It's quite a remarkable story if you think about it. That's a democratic, capitalist society who managed to thrive next to the communist behemoth coming out of that period. How did it do that? Two ways. One, it made sure it stayed on the right side of the Soviet Union, or didn't make itself entirely vulnerable to that power. And it also got busy creating a resilient, dynamic, uh, high wage economy that allowed it to create more and more and more of that resilience as it went on. So to me, Canada should look at that kind of model, and I sense that the Prime Minister is doing a bit of that by just like taking intentional steps in creating a more productive economy. And I mean, that's the answer, in my opinion.
It's a news cycle that's kind of trends towards hyperbole, or it can certainly encourage hyperbole. There's so much going on. We're only 20 days into 2026. We've set the stakes quite high by saying it's a make or break year for Canada's economy. In what ways is it a make or break year for Canada's economy?
Do you want me to take that one?
Yeah, go for it.
Look, I'm the guy who's been writing the productivity narrative for a year and a half or so before Trump even came along, so I can fill up the rest of the time if you want. But but look, that's the productivity crisis that preceded Trump is the reason I think that we all felt so vulnerable when he started talking about the 51st state. I mean, we built our economic policy around easy access to the world's most dynamic and biggest economy. Seemed like an excellent idea for a while until it wasn't. And now we're kind of stuck in a moment where we've got a decent amount of wealth, so that's a positive, but we've not built the kind of companies, we've not built the kind of mindset that allows an economy to thrive in that sort of environment. So you know what? Honestly, it is hyperbolic, James, absolutely, but I don't know, maybe that's the way to keep Canada focused on what really matters here. And we've got to get serious about these questions. I mean, when I started writing about productivity ad nauseum, all kinds of eye rolls, because of course we've been writing about productivity ad nauseum for 2 or 3 decades. But up until now, those productivity op-eds and columns and stories they were something of a cottage industry because we had the luxury of, easy access to the US, and we are able to support our society by just sending them stuff. We can't count on that anymore. So it is time to get serious on all these questions that we've been rolling over and over and over for so long.
Yeah. And Sharon, hopefully you can help me read the tea leaves of the market. 20 days into 2026, what are you seeing out there right now, and what are you keeping an eye on in the coming weeks and months as some of these big disruptive, often chaotic things that Jimmy was talking about at the start USMCA, Venezuela, Greenland, probably USMCA more than any. What are you looking out for in the coming weeks and months on the markets?
Yeah, truly, it's only been 20 days, but it feels like a lifetime given the state of the news cycle. So I think a couple things. I think markets are realizing that the global uncertainty is here to stay. There was a wide sell-off this morning, for example, in stocks, bonds, the US dollar, and crypto. US futures had already dropped on Trump's tariff threats over the weekend on the eight NATO countries for supporting Greenland. We saw this morning that the Treasury sold too, and that kind of pushed yields up. On a broader point, I think the Sell America trade that we saw when Trump first imposed his so-called reciprocal tariffs on Liberation Day is returning. It's not quite the bloodbath that we saw back then, but in terms of kind of looking ahead, I think that that continued uncertainty around geopolitics could put more renewed pressure on the US dollar. And I think we might also start to see investors demand a higher risk premium for holding US assets too.
And Anita, let's go from markets to a specific industry. You've spent several years covering the Canadian auto sector for the Logic. Carney's deal with China in recent days was big news there. What does that deal mean for Canada's struggling auto sector? And what does 2026 look like for that sector in particular?
Yeah, so we heard Mark Carney be asked about this in Davos this morning, and he responded that there are clear guardrails on our relationship with China. What he did not say is what are the guardrails, and I think that is something that the auto sector and everyone else are very interested to know. If we take a step back, coming into 2026 was already a huge tipping point for the Canadian auto sector. We have a crunch period between July and September. In July, we start the USMCA review, and in September, Unifor, who represents the union that represents auto workers, will start negotiations and preparations for their next 3-year contract. So there is a chance here or a risk that very heated rhetoric around trade in the summer helps determine the contracts for auto workers well beyond Trump leaving office. So Jimmy alluded to this very well at the beginning, this idea of another white knight coming in and providing investment for auto manufacturing. The question is whether China could be considered a white knight. We know that there are a lot of questions about the employment conditions in their auto manufacturing sector, and also cybersecurity, IP protection. So it will be a very complicated question about whether we welcome those types of investments and what the guardrails are of what we won't accept. I noted that we didn't hear a lot about critical minerals in our relationship with China. That's something that Canada has blocked pretty heavily in the past few years. And it's not really clear if that's one of the guardrails that we're not going forward on. But yeah, a lot of questions to come in the next few months.
Yeah, with regards to the looming question of guardrails, whatever they may or may not be, we've already got a bunch of questions in, and I want to turn to one of them now from Harold. He asks, and maybe this is one for both Kevin and Anita, do you think Canada / Carney are likely to continue to partner with Russia and China despite the cost of these regimes and others like them, I suppose, supporting bad actors and worsening geopolitical instability?
Do you want to go first, Anita?
Well, I guess Mark Carney said this morning, Prime Minister Carney, that they're our second biggest trade partner. And he said last week that, he's going to stick by Canadian values. He's going to prioritize partnerships with like-minded allies, but at the same time, he has a realistic view of what it takes to, build Canada's economy. So to me, my takeaway from those initial remarks, not knowing the details of our agreement with China, suggests that he is interested in continuing talks there. With Russia, things seem a lot more limited. He came out pretty strongly against Russia this morning, but I'm definitely interested to hear what Kevin thinks.
Yeah, I think Russia's off the table for anyone in what we define as the West. So no worries there. China is an interesting case, and I'll echo and then maybe advance some of what Anita said. I really think that the Prime Minister is approaching this on a one-off basis, and what I mean by that is that so China. I'll take a step back. Sorry. Let's not forget that Mark Carney is like Liberal leadership candidate. Mark Carney described China as Canada's biggest security threat. So let's all assume that there are real limits already in place that will define the extent to which the country or we are going to engage with China. But I talked about Finland in my first set of remarks. I mean, Finland continued to trade with the Soviet Union, even though they were poles apart. And the Soviet Union was certainly an existential threat to that country. I bring that back just to show that the countries continue, trade kind of is organic and it happens on its own. And then nation states set their own parameters sort of based on security and other issues. So in this case, what I see the Prime Minister doing is trying to unblock an important market for Western canola farmers. Why is that important? Well, let's not forget we don't talk about this quite enough probably, and perhaps I'm sure we will as it starts to sink in, but we might have two referendums in Canada this year. And I do think that we need to keep in mind with all that the Prime Minister is doing is that he's trying to weigh these two internal threats to Canada's stability going forward. And so I really think, given the extent to which some of the Western premiers came out sort of demanding that something be done about that, and it's time to stop trading canola and Western grain off against the auto industry, the Carney had a lot of pressure and a lot of reasons to try to do a deal there. And I might hope we might hear from Anita more on this later. I don't know that the kind of the quota on China EVs should really upset Canada's future as an automaker one way or the other. I actually sort of look forward to perhaps just a little competition there, maybe to
Yeah, I
move
mean,
the sort of.
Anita, I mean, Kevin said it there. So put the question straight to you. How much does that deal with China throw a bit of a spanner in the works of Canada's auto sector, or is it a boon?
I think there's a sense we're buying a bit of time. Obviously, they have to harmonize the standards with the Chinese companies. So I think the idea is that the first couple of years of this, we're going to see mostly Western automakers that manufacture in China fulfill that quota. And the hope is that we have a hockey stick of growth of EV adoption in those intervening years. And by the time the Chinese automakers are all harmonized, it is quite a small, single-digit percentage of total EV sales in Canada. Obviously, that is the best case scenario that we're thinking about. There are lots of other scenarios. So who knows what will happen, but that's kind of how they hope the numbers will work out.
Yeah, interesting. Let's talk about another kind of deal, and then I'll get to some more of the questions that everyone's been sending in. Please do keep them coming. They're much better than mine. Given the trade volatility with China, with the US, with everything that's going on 20 days into 2026, Sharon, are you thinking that Canadian CEOs are actually ready to pull the trigger on deals, or can we expect another quiet year for Canadian M&A and IPOs?
Yeah, so I would say that it wasn't a quiet year at all for M&A, at least last year. M&A rose 60% to 266 billion in the first 10 months of 2025, and that was driven by a lot of large strategic deals, even though the overall deal volume slowed, and private equity accounted for a lot of that. There was a lot of momentum in the energy and the material sector, and there's also a record levels of global corporate debt sales in 2025, and a lot of that is in part due to a rush to fund AI infrastructure, but M&A is also leading kind of a rush to borrow, and you're seeing foreign businesses, Canadian businesses, all issuing bonds. On the flip side, the IPO situation looks very different here. Globally, it was one of the best years since 2022, but it was very quiet in Canada. And putting aside ETFs, there were only a handful of corporate IPOs on the TSX. I want to say 3, maybe. Brookfield backed Rockpoint was one notable one. But I think there are still some positive signals. One of them being that, TMX CEO John McKenzie had said that, and this is, I guess, well known as well, that the US leads in having a deep pool of liquidity, but he's also starting to see deals come to the market. So I think that there are certain conditions in place that could lead to some kind of revival. And the last point I'll make is that the TSX and S&P Composite has really outperformed US equity indices, and that's been buoyed by the energy sector. Energy, materials, financials, gold have performed, but more broadly, equities have really been outperforming. So I do think that those conditions will kind of lay the groundwork for more deals and potentially the IPO window opening.
So in terms of 2026, there are some positive signs there that on a strong foundation in 2025, things can continue to go in the right direction this year. We got a bunch more questions from people watching along. A really good one from Shane McKenzie, which I'm going to kind of paraphrase. He says, on interprovincial trade, which I guess is the other kind of deal that Canada should really be talking more about, and Carney's been talking about it at Davos. Shane writes, it seems that several provinces have stalled or at least slowed the universal one market dream that Carney is continuing to sell at Davos. So what needs to happen for that dream to become a reality? Maybe to you first, Kevin.
Yeah, okay. I have thoughts on what needs to happen there, and probably I should write them into a column pretty soon. What needs to happen is for the Prime Minister to come back from Davos, remembering that he said that to that audience, and become a real leader, or at least appoint someone to lead that file and start banging heads together until these guys get this done. What I observe happening, and look, I'm obviously not keeping tabs on this on a weekly basis, so the proviso here is perhaps there's lots being done and just we're not asking the right questions, or everybody's so busy they don't have time to advertise what they're up to. But Shane's point is shared by lots of people that I do talk to, that momentum really has slowed. And I think we can guess, in fact, we know why momentum is slowed, because all those interests behind all those rules and barriers that are in place are digging in their feet and raising questions, et cetera, et cetera. Basically, the reason that this remains an issue to this day. So look, the only way to get this over the finish line is for someone at this stage to engage and lead on the file and make it a political issue and remind us on a regular basis about why this is important and why this isn't getting done. That's what's missing at this stage, is that the federal government is obviously the best place to do that. They did their bit early on. And then they appear to have sort of walked away and left it to the provinces. 12, 13, 14 people in a room is not going to get to a resolution very quickly without somebody there with the clout to move them along. So I really think it's the moment for the federal government to take over a leadership role on this file.
And that whole question of interprovincial trade is tied up in the question of Canadian productivity. What are the levers and the pulleys, the switches, the whatevers that we can grab to boost Canadian productivity? A panacea that's being held up quite a bit, rightly or wrongly, is artificial intelligence. So Sharon, I'm going to throw this one to you. You get to take on the AI boom or bubble question. We're in the midst of something with regards AI. What I'm interested in is what companies are starting to see returns, and what are those returns? Where is AI actually paying off?
Yeah, I think Jimmy John kind of alluded to some of this in his remarks, but I think part of the first thing that makes us answering this question challenging is that it's very hard to define, ROI. It's still relatively nascent as a technology, even though we have seen big gains in the past year, but it's hard to measure, and it's also hard to have an apples to apples comparison because every business is probably measuring it in a different way. What I will say though is that there has been a major uptick. So 93% of business leaders now are using AI, up from 61%. That was from a KPMG report. And we're also starting to see more interesting use cases that are going beyond, chatbots. So even in the banking space, for example, we're seeing banks use it for fraud detection, loan adjudication, credit risk modeling, to name a few things, predictive analytics, all kinds of things. A lot of the Canadian CEOs, I think 78% are saying that AI is a top investment priority and probably will be going forward. And to address your other point about, AI boom / bubble ? I think that there has been a lot of debt financed AI spending. So a lot of companies are spending a prodigious amount on the underlying infrastructure that's supporting this AI boom. And that, begs the question of, does that lead to a potential data center glut that we'll need to deal with? The consultant Bain has said that we need $2 trillion US dollars by 2030 to fund this computing power. And I think that the current state of the economy, and my colleague Murad Hamadi definitely has way more thoughtful views on this, but I think it's accruing to a handful of model makers. So I don't think that payoff will be spread evenly. But I think the one thing that business leaders are having to contend with is the realization that if you don't adopt it, you will kind of fall behind. So.
Yeah, on adoption, Anita, you cover some of the biggest companies in Canada, right? Major consultancies and law firms, big storied companies. How is AI actually changing their business models or the way they do business? How are they using AI?
Yeah, so obviously consulting firms and lawyers they service all the other industries. So they are kind of hearing things from their clients and also trying to implement them internally. So I think a lot of it comes back to what Jimmy said at the start around confidence to invest. Obviously, it has been an uncertain time period over the past 5 years for companies, but in Canada specifically, the lack of business investment growth has predated the pandemic. It predates tariffs. It's sort of a stagnating problem for the past decade. And we're kind of at this transition point where I think early in the AI adoption process, it was fairly easy to invest in AI. These companies had, just tons of venture money flowing into them. They didn't need to charge a lot of money for you to use ChatGPT and play around with Gemini and, all of these other models. So it was sort of a low risk way for companies to spend their time as they were dealing with supply chain issues and uncertainty around bigger projects. Now we're not in that place anymore. What we're hearing from places like Accenture is that there are investments happening in bigger, longer term AI customization projects, and those are going to take a lot of time to turn into revenue. And in the meantime, a lot of those pilot projects are causing some hiccups. For in the accounting space, for example, there was a survey by a company called Dext, and they talked about how 44% of the accountants in Canada that they surveyed are spending 3 hours a month correcting AI generated errors from their clients, and then another 27% spend 4 to 6 hours a month correcting AI generated mistakes that their clients have brought to them. So we are in a space where maybe there is some long-term investment in productivity, but there is also a short-term kind of fracturing where we're maybe seeing the opposite of ROI in some of those cases. So that's part of the make or break feeling I think that we have going on right now.
Yeah, and of course, all those people correcting AI mistakes are actually just training the AI, of course, but not with billable hours, I'm guessing.
And
Kevin, I wanted to, sorry, yeah, go ahead, Sharon.
No. I just wanted to ask, Annie, I know you've done some reporting on kind of AI fatigue or the silicon ceiling, I think is one way that BCG has put it. Could you tell us a little bit about that and kind of how that's, I guess, one of the things that businesses are having to contend with as well?
Yeah, so we're seeing a bit of tapering off of sort of new or increased adoption of AI. I think a lot of companies have gotten to sort of a baseline where they can say our employees use AI. But there's sort of a slowdown in increased experimentation or new applications. And people aren't really feeling that they have enough training to get to that next level of productivity that they're expected to deliver. And this isn't just a Canadian problem, it's a worldwide problem, but obviously we are focused on our productivity and getting ahead. And so I think there is a big push within a lot of companies in Canada right now to actually go back to the basics and do in-person training, do personalized training to make sure people actually understand the tools that they're working with.
Kevin, a nice easy one for you from someone watching along. Jalila asks, Kevin, what do you see as the crux of Canada's productivity problem? Is it red tape, the tax structure, infrastructure, skills, education, or a combination of all of these factors?
All the above, plus, and I can't prove this, and so people will dispute it, but it's partly a cultural issue. And it gets back to all the sort of historical allusions that we've been making throughout this conversation. Uh, but Canada's never really had a moment like this one, a moment where it's been forced to test itself. We've always been a node in some benevolent empire, and that was a comfortable place to be, which means we've never had a moment where the country has had to sort of decide what it wants to be and what it's willing to do to maintain a certain amount of independence. So my own view on this and my own view of an underdiscussed part of the productivity problem is that we just don't spend enough time thinking about the dark matter that sort of fills the space between everybody's economic models and policy levers that would presumably bring a sort of rational reaction that you'd expect. We've pulled a lot of these levers. We've tried a lot of the things that you're supposed to do to generate, world-beating innovative economies or companies. They kind of work, but obviously, given what we're seeing now and experience now, they haven't worked well enough. Why haven't they? I think because we've frankly just never had to face the kind of friction that we're about to face now. So this is, to me, why this is such a make or break moment for Canada, is that we have our moment where this is our historical moment to decide, as I said, the kind of country we want to be. And if we decide that we want to be we want to create a certain amount of independence from these great powers, then we'll start to make some of these difficult decisions that we've been putting off for so long because we've had the luxury of being able to send goods and services to the US. So bottom line, like that to me is the missing piece. Yes, tax is a problem. Regulation is a problem. We haven't really thought hard about these issues for decades. It's time to do so. But we need to think that the reason we haven't done so is because we just haven't had to.
Yeah, Sharon, I asked you a question towards the beginning about the markets and what you're seeing there, and an interesting question from Jerry that I'm seeing in the chat. They write that there's a lot of talk about increasing the pace of investments, right? There's TV ads, there's Carney at Davos. Everybody's talking about the need to attract more investment in Canada. So Jerry asks, do we see any real interest in aggressively changing the Canadian landscape for investment, taxes, regulatory policies, consultations, etc., to attract more capital? Or is it going to be the case that only government-run projects get done and they, as Jerry puts it, are poorly managed and costs are uncontrolled?
Yeah, well, I mean, I think yes, I think there are definitely measures to increase capital, some of which Kevin has outlined, but I would also push back on the fact that, there is already a lot of capital that's sloshing around, and whether it be through institutional investors, through pension funds, or otherwise, I think Canada has a very kind of robust financial system to begin with, a very strong monetary framework, and I think that kind of certainty is something that investors are looking into, or rather they not looking into, but that they see as a positive attribute of investing in Canada's economy. So I think it's almost about corralling the capital in the right places rather than trying to find where it is coming from and attracting it externally.
Yeah, I'll tack onto that just quickly, James. I mean, all the various offices that Carney has set up are ways, in my opinion, or the way I look at them, are just ways to hack a system that's just slowed down for because of neglect, essentially. So that's all about cutting through the regulatory morass to make Canada more investable, to use the word from Bay Street. And I think it's also just part of getting the flywheel going, to borrow a word from venture capital. I'll borrow a word from the English language promise in a second, but that's how I see it. That's the frame that I put on these things. That is a recognition that, yeah, Canada has become a if not a difficult place or an impossible place to invest, less than interesting place to invest. And so Carney's trying to make us a more attractive place to do so. And whether it's the major projects office or what, Anita, maybe you know, the housing office, whatever it's called. I mean, these there's a half a dozen of these things, I feel like, now that he's set up, just to make it that much easier for big international investors to come to Canada, get somebody on the phone, and figure out what they have to do to put some money here. So it's a positive to me.
Yeah, maybe Anita, to use the auto sector again as a bit of an example. Is there an opportunity for the auto sector here to grab hold of some of that money that Sharon said was sloshing around and save itself from the brink and to build strength from a point of real crisis? Or does Canada not really have that opportunity given what Kevin's laid out in terms of sort of the geopolitics of economics that we're all living through?
So I think if you look up the battery supply chain, electric vehicle battery supply chain into the critical mineral space, where a lot of the automakers have invested in Canada already, you know, Mark Carney talked again this morning about how one of his priorities in Davos is to create a critical minerals buyers club. We've seen this type of rhetoric out of the United States as well, where they are basically just put out an order saying we want to negotiate price floors, which is something they were already doing. But we also, as Sharon alluded to, have a lot of money sloshing around in the gold industry. All of this uncertainty has had the side effect of pouring capital into Canada's gold miners, and a lot of them have money to invest right now in critical minerals projects and forward-looking projects. There's a lot of M&A going on in the copper industry. So there's a ton of capital sort of at play in that space. And so I think that could be an interesting place to look, and something that certainly the Major Projects Office is trying to address with mixed results. But yeah, that certainly seems to be a big priority going into 2026.
And Kevin, I'm going to come back to you. Another priority for 2026 at more of an individual level is the cost of living, right? So you wrote recently they're in the midst of a vibes session. I'm going to ask you to explain briefly what you mean by that. But broadly, what we're seeing is inflation is stabilizing, but households aren't feeling it. So what's going on and what can be done to fix it this year?
All right. Thanks, James, for opening me up to some more hate mail. But I'll be provocative for the sake of simplicity and to try to help us think through what's going on. So what I argued in a recent column is that the vibe session, the affordability crisis, to a certain extent, and I want to say that, you know, stuff is very real to a number of people. But to a certain extent, it's in our head. And it's in our head for a couple of reasons. One, we're not good at updating our priors. We're not good at relativity. And unfortunately, and this has been shown by behavioral economics, we're not particularly good with numbers. So the best way to think about it, in my view, is just to look at what's happened with wages and the price level over the last number of years. So certainly the price level took off far more than wages, far more than any of us were ready for coming out of the pandemic. And it's like nothing we've seen in decades. And I think that's now the story we carry around in our heads. We look at those prices, they're a lot more, they're bigger than we remember them being. They're bigger than we think they should be. So we feel like we're facing a terrible affordability crisis. What we haven't noticed is that our wages have caught up and passed that price increase. So we're kind of back to where we were. And so the way to correct it, the way to continue to push forward, of course, is to keep wages growing and get far ahead of what's happening with inflation. Inflation is now stabilized around the Bank of Canada's target of 2%. It's been there essentially for a couple of years now. So this is the moment where we can sort of put this affordability crisis behind us by accelerating those wages and making sure that we've got the kind of economy where everybody feels like they have a chance to get richer. Unfortunately, I mean, back to what Jimmy said and what we've been talking about about productivity. Productivity growth is essentially stagnant. That means wealth growth is going to be essentially stagnant because essentially companies aren't making wide enough margins to be able to raise our wages. So we've got to address this, and by addressing this, we fix. It's a way to attack all these problems that we're talking about, and affordability is one of them. So that's the answer. I got a lot of email from these every time I write about this and ask everyone to think about it. I get lots of, important anecdotes, frankly, about people for whom this isn't in their heads. It's very real. So I don't want to diminish that, but I just don't think it's necessarily the crisis that we make it out to be in every poll that we see, where affordability ranks at the top, well ahead of some of these other existential questions that we've been talking about today.
So please do keep sending emails to Kevin every time he publishes a column. That would be my one ask for today. We've had so many questions in the chat, and I'm sorry I'm not going to be able to get to any more of them because we're pretty much out of time. But thank you so much for all of the really, really detailed, smart questions that everyone sent in. Really do appreciate it. I'm going to ask one final non-detailed, very not smart question that you're all going to hate me for, but let's go for it. What's one thing that will surprise us all about the Canadian economy by the end of 2026? Who wants to go first?
All right, I'll go first. Look, I'm going to say what will surprise us is we're going to start to see the agriculture industry, the food industry emerge as an important cog in the Canadian economic machine. So much potential there. It's perhaps the one place where we have real comparative advantage right now. Lots of interesting things happening in agricultural technology. It's an opportunity, frankly. We get back to your original question about pivoting off the prime minister's table or meal analogy, James. I mean, it's one way for Canada to have a ticket to basically every conversation that's going out there. Think about it. Security is not just worrying about who might attack you or who might kind of try to take your territory. It's about feeding your people. So food security is a part of the conversation. Canada is uniquely placed to be a big player in that. Probably a lot of us think we already are. Frankly, we're not. We're so-so players in that space. Lots of room to grow there. And I think that, I'm confident or, relatively confident, fairly confident that we might see some real interesting things start to happen there.
All right, Sharon, I'm going to come to you next. Briefly, what's one thing that's going to surprise us all by the end of the year?
I think going back to my previous comments, I guess, on the IPO market, I think one thing that would be surprising and would also be a good bellwether is the IPO market picking up. Also, kind of more cross-border deals with Canadian companies in terms of M&A, but being acquirers and not just targets. As you know, Canada is known for creating really sellable companies, but terrible at helping them scale. So I think that's one thing. Another thing I would be surprised to see, or maybe not surprised to see, but I would see more kind of activity in this space is Canadian companies taking up more of the kind of the picks and shovels in AI, so to speak. So we already have companies like Brookfield and insurers that are investing in and operating data centers and starting to see some of the secondary benefits of that. I think there are a lot of small cap industrials and infrastructure plays that are tied to energy and defense and really at the nexus of everything we've talked about that aren't sexy tech stocks, but they'll see pricing power and they might see a really good year.
Great, thanks. Anita, to you, what will be surprising us all by the end of 2026?
Yeah, I'm gonna take a bit of what Sharon said and also a bit of what people are talking about in the chat, and also talk about M&A. I think there are going to be some major companies at the end of 2026 that don't exist right now because of M&A deals that are on the horizon. I think if you think about striking trade deals with new countries, if you think about overcoming interprovincial trade barriers, if you think about this move from being a first AI mover to competing where everyone's using AI, the common denominator that helps you deal with all of those shocks is increasing the scale of your company. And so what I'm hearing, like across many of the industries that I cover and talk to, is that appetite for combining customer bases, combining manufacturing supply chains, combining AI talent bases to help better compete on the global stage. So yeah, I'm looking forward to seeing the interesting new names that some of these global combined companies pick, and as Sharon said, hopefully we see some Canadian leadership there.
And a final question, just because it fits so perfectly. Noah, who's watching along, question for you, Anita. How does the manufacturing sector fare in 2026?
I think last year what we saw was this kind of some band-aid measures that the manufacturing sector had to pick up to deal with this, what they thought was temporary situation of tariffs. I think, if you think back to this time last year, there was this idea that um, Donald Trump was in deal making mode. We were going to have a deal by, July or August. And so they were kind of rerouting things, operating temporary warehouses where they kept their goods over the border, or having temporary places where they did some final assembly in different countries to get around tariffs, or making deals to sell IP or software or things like that abroad while they tried to figure out what they were doing with their physical production lines. Um, I think, with the USMCA rhetoric this year, they are realizing that these are not band-aid solutions, that this is the new reality, and that's going to be very difficult if you are carrying a kind of band-aid solution into 2026 to build your foundation on top of that. But I do think there are some opportunities. We've heard from companies like Linamar, auto parts manufacturer, for example, that there are other suppliers that are distressed that they see opportunities to combine with and purchase. So yeah, I think there are definitely companies that have been thinking ahead, have been investing in AI, and have had come up with smart workarounds on their supply chain, then that will stand the test of 2026. So it will be difficult, but I think there's opportunities for some winners as well.
You mentioned the USMCA there, and Jimmy mentioned it right at the top. There is so much going on right now that we haven't really got into the details of. One of the most significant moments for Canada this year, which is going to be the renegotiation of that deal with the US and Mexico. And it came up in a few of the questions sent in by people watching along as well. Just to let you all know, I'll be sharing all the questions that you sent in with the newsroom. There's loads of interesting lines of inquiry here for all of us to pursue. So thank you so much for all of those questions. We're almost out of time. What I'm hearing is there's optimism, but there's a lot of work to do, and it's going to be a busy year. So thank you so much to everyone for taking the time to join us today. If you're not already a subscriber, you can find a link to subscribe in the chat or visit the Logix website for more details. Thanks also to my colleagues Kevin, Sharon, and Anita, and to Jimmy Jean and Desjardins for their sponsorship. If you enjoyed today's event and would like to learn more about how you can get involved with the Logic, please do get in touch with our partnerships team. Ariel Lepper-Walker and Emily Wozniak are ready to speak to you. Also, please do save the date for the Logic's 4th annual Subscriber Summit, which will take place in Toronto on November 2nd. Thanks again to everyone who joined us today, to our panelists, to our sponsor, and the team behind the scenes for making it all happen. Have a great day. Goodbye.